Graham Neilson is a risk strategist with almost 20 years of investment experience, and he's a chief investment strategist at credit asset manager Cairn Capital, which oversees $25 billion. Now, he joins us now. Graham, thank you so much for being on the show. Wow, you're pretty, as long as you have a good stomach, this is a good time to buy. What would you be buying? Equities, and how do you position yourself in these equities?
Well, I'm a credit manager, so I'm buying credit.
Okay, what kind of credit are you buying?
Well, I think in order to give you a context in terms of what we're looking at, it's important to look at why we think we're here. So 4 or 5 months ago, our view on risk assets generally was twofold. Number one, growth expectations are way too high. And number two, allocations to growth assets are way too high as well. So at that point, didn't like high yield, didn't like equities, didn't like commodities. Now, people are allocating out of equities, well out of high yield, slowly moving out of investment grade, and they've certainly moved out of commodities as well. And there's a big crush for cash.
Because people are fearful. Very
much so, yeah. Fear is a huge factor. Now, that usually provides some of the ingredients for an opportunity set. However, I think that while there may be opportunities in the short term, there has been a significant amount of damage in terms of the marketplace. And I don't yet think we've seen the worst of the economic news flow to come through either. So I think while there's opportunities, you have to still be patient.
But still be patient to be buying. So you wouldn't be buying now and being patient. You'd say just wait until the next div and then you buy.
Well, I would be buying some assets now because I think if you look at something like high yield or certain high yield assets, they are trading it and pricing in a similarly recessionary environment to perhaps mid-07. 2002 and the early part of 2008. So I think that they price in more of a recessionary risk than equities do. So I think while volatility has peaked or is peaking, I think equities could remain vulnerable if they go any further higher. But I think high yield's a better place to be.
But which one specifically? Are you looking at specific countries that seem to be faring better than others?
We focused predominantly on Europe. I think fundamentally and structurally, Europe is still a very difficult place within which to operate as a pure economic backstop. I just do think that the officialdom remains wholly in denial. Growth expectations as far as official forecasts are still way, way too high. But I do think that this will throw up a huge amount of opportunity, particularly for credit players, because credit is the single biggest driver of all risk everywhere.
In the peripheral countries?
In the peripherals, in the cuspy countries that I would describe as Spain, Italy, Belgium, and in the core as well. The core have to pick up the bill, and the ECB has to change its tack and make a major, major monetary U-turn over the next 3 to 6 months.
Is the UK a safe haven?
In relative terms, yes, it is.
Will it stay a safe haven?
I think it will do, as long as there is enough realism in terms of economic fundamentals within the central bank, and we continue to do the correct type of work on the fiscal side. I think everywhere in developed Western markets is already in some kind of recessionary type of environment. So being a safe haven for currency flows, for bond flows, yes. For equities, not so much.
So when would you, you're expecting a little bit more of a dip. Is this 5%, 6% of a dip, and is this going to happen in the next couple of weeks? How do you actually foresee the volatility in the market playing out, and when is the perfect time for an investor to come in and swoop up bargains?
Well, I think actually over the last few days you've seen some very, very good opportunities, because there has been some pretty rank panic in the market, whether it's in high yield, loans, in financials, whether it's in equities or in Tier 1, for example. So the last few days and over the next couple of days, I think there's a good chance we see a pretty sharp rally. But I do think that...
But it'll be short-lived?
It will probably be short-lived, yeah. And I think that actually over the next 2 months or so, once you see economic reality coming out, combining that with a much more concerted policy change, whether it's in Europe and the US as well, that actually the opportunity...
So you believe the politicians and actually the policymakers are right behind us? An optimist, Graham.
Well, I think given the market moves that we've seen, you have to be a little bit more optimistic. I was hugely pessimistic in the first quarter and the second quarter, but now I think policymakers are going to be forced, whereas before they are almost ingrained in terms of the way that they have to be reactive. And because they're going to react to the things that they've already seen, such as stress in the banking market, banking liquidity, worse economic numbers coming through, the door is already opening to further monetary measures from the Fed, and I would hope as well the ECB swallowing a bit of pride and moving as well.
Okay, Graham, thank you so much. Graham Neilson there.